Well, tonight, as I said, we're going to do some crystal ball gazing with John Taylor, Investment Servicing Manager at Liberty Corporate. John, welcome to the show.
Thanks so much, Michael.
On the line, we've got Anne Cabot-Alitaza, who's the rose amongst the thorns tonight, head of Alexander Forbes Research Institute. Anne, always good to talk to you.
Hi, Michael. How are you?
I'm doing well, thanks, and really looking forward to this final discussion. In studio, we have Mike Brown, the MD of ETFSA.COSA. Mike, welcome to the show.
Thanks, Michael, and nice to talk to your listeners as well.
And finally, we've got a packed panel tonight. Hannes du Plessis, who is part of Citadel Asset Management and Citadel Manage Investment Solutions for the Citadel Group. Hannes, welcome.
Good evening, Michael. Thank you.
Right, we've really gone through the passive universe this week, and I'd like us to do, as I said, a bit of crystal ball gazing. PwC predicts that the passive industry is going to increase its market share from about 5% of total assets under management globally in 2012 to just over 10% of total assets under management by 2020. And it reckons a key driver of this is that clients are expected to focus more on costs and interrogate the value add of the active managers out there. And really the most important decision that any investor makes is to decide on how to invest for the long term and which asset classes to allocate money to. And it's what role that the ETFs and the ETNs and the other passive index strategies play in achieving this. Now, Mike, just to get us started here, and really, it's one of a trend here that's been around actually for quite a long time. Why do you think all of the attention now on passive strategies, on ETFs and ETNs at this stage of the game?
Well, I think what we're seeing is a number of surveys coming out around the world, and by neutral providers of surveys, S&P and Morningstar and people like it who collect statistics. And they're saying that 85% or so of active managers can't outperform the index over time, whatever index you use. And that's something that I think people have been thinking is possible. You know, ETFs possibly will outperform most active managers, but now we're getting a lot of statistics telling us that. And so I think that's focused a bit of attention on why passives do in fact outperform. And when you start analysing that, it's not only lower costs, but it's because the passive market now and ETFs can give you access to any asset class or any type of market sector. So you can put together an asset allocation strategy that can handle not only rising markets, but markets moving sideways or markets even falling, because you've got various asset classes that you can access through passive ETFs to give you something that can survive even the very volatile markets that we're seeing at the moment. And so I think the way the markets are going is also helping develop ETFs.
That's an interesting point, because when we really peer into our crystal balls and talk about the way we see markets running to 2020, the general consensus seems to be we can't expect the same kind of returns that we've seen in the period post the global financial crisis. We had QE, a lot of money swishing around the system, looking for returns, pushing up valuations on stock exchanges globally, and that perhaps has come to an end. And as we know, John, market downturns tend to favour the active manager. So what sort of impact do you think this will have on the momentum built up behind passives over the last 7 to 8 years?
The critical thing, as Mike says, is that the number of passive products, or probably better called index tracking products, has broadened considerably, not just globally but even in South Africa, to a point that there are suitable indices to track and suitable products out there which can work very well in a sideways moving market, in a downward moving market. And those type of products are often mislabeled or not, called vaguely smart beta or similar kind of names, fundamental indexation, etc. The idea there is really to make sure that the way in which you are accessing the investment universe is at an appropriate price and is coming through in a manner that really is efficient and matches the risk really that you're prepared to take.
Interesting point that you raise there, risk. And when we look at this, last night we were talking about the whole core satellite strategy and the fact that very often we're now seeing index tracking type products forming the core part of a portfolio. It'll give you the beta. It's almost predictable, and I say almost advisedly. Nothing is guaranteed in this world. But then the core part of the portfolio will give you that alpha, and it allows the manager to be far more aggressive in pursuit of that alpha. Will this hold equally true in a downturn?
Okay. Well, first of all, I hate this concept of core satellite, because effectively what you do when you throw in a lot of, pure index fund solutions is that you just end up diluting the alpha. And there's a lot better, much more clever ways to do this away from a core satellite point of view. But I think I'm not even sure we're even onto the right discussion if we're talking about the future in that crystal ball, because I think what's going to be driving the support around indexation and about passive portfolios has a lot to do with the fact that there's the bulk of the money that's out there is compulsory money in the markets. It's not discretionary money, it's compulsory. It's long-term investments. And what's taking over the industry, and the real industry disruptor that's happening internationally, are these kind of solutions-driven investments, like that are driven by robo-advisors. It's driven by what we call algorithms, sort of an automatic system that says, given where you're trying to get to, given how much funding you require, given that long-term target and how much time you have to get there, what's the lowest cost solution we can put in place that has the highest probability of getting you there? And those are what are going to be taking the market by storm in the future. They're starting in the U.S. They're going to hit South Africa big time. And the whole issue of active versus passive is going to be a mood issue. It's going to be what combination of the lowest cost sort of building blocks will get me to where I need to get to in the time that I have. And that's what I think is going to drive the market. So
that's good. I love a contrarian view on the panel, and I knew I could always rely on you for that.
Well, don't get me on passive versus core satellite stuff.
You should have been on last night. I would have loved to have Narina respond to that, but I don't want to get too sidetracked.
She'd agree with me.
But she seems to be a bit of a fan of the core satellite strategy, though. Let's talk about the robo-advisor here, and what impact do you think that's going to have on price discovery?
Well, I think the reality is that you can offer these things to clients without these interfering and nasty things called commissions and advisor fees and all that kind of stuff. And you can do it with ETFs, and like Charles Schwab is doing in the U.S., and they own the ETFs and they own the algorithm that tells you what the combination is that will be optimal for you. I mean, that's a really, really winning low-cost strategy. And if I'm sitting there having to try to figure out what my investment strategy should be for my retirement fund or my children's education or any specific goal you might have, you just pop in that time frame, pop in your, what you require and when you need it, and the building blocks do all the work, because it's really about that strategy and asset allocation that's going to be driving that outcome, not whether, Coronation outperforms Alan Gray.
I hear what you're saying there, Amber. What worries me about that is when you use such a cold algorithm, you certainly might lump certain companies that tick all of those boxes into an index that perhaps have other unseen risks to them, social, environmental, governance risks that algorithms can't pick up. Political risk. I mean, how do you design an algorithm for political risk?
Well, how do you design an active manager for political risk? They probably have just about as much probability of anticipating political risk as a... But I think this thing about the social responsible investing is really a red herring, because there are plenty of indices that are being designed today that have that built into them. So you can pick that characteristic if you want. There's nothing that you can't put into a what I would call a passive strategy or an algorithmically driven strategy.
Very good point. Hannes, I just want to move it along a little bit here and throw another variable into the pot here, and it's that whether you're invested in active, passive, index, smart beta, you're employing robo-advisors, I think one of the important questions really is more along the lines of behavioral finance. Am I on the track to realize my financial goals and objectives? And it's perhaps something that gets lost out in this debate.
Sure, Michael. That's a very interesting question. One of the difficulties is precisely defining investment objectives, and it's one of the most important steps. It is entirely likely that most investors haven't really given this enough thought at all. So say for a moment we have an investor who's really crystal clear about objectives, who understands the objectives and understands how to formulate investment objectives in a multi-period type of a setting. Then one of the interesting points is that you need to be able to be very, very transparent in your own portfolio about what risks you are taking and how well you are controlling them. This specific risk management function is something that we believe the new indexation, enhanced indexation or alternative beta space can do very well, because it can be very explicit about how it manages its risks. So whether it's a robo-advisor doing the job or a traditional portfolio manager doing the job, if a portfolio is fine-sliced in terms of its risk structure, you are most likely to have a better outcome, provided that those investment objectives were very well defined in the first place.
Yeah.
How do we, well, I suppose, one can design an algorithm to be able to tease out all of those questions in a very linear sort of fashion to get you to that level. I just, from the outside, as a consumer of product, would prefer to be able to sit down and eyeball someone and say, this is actually what I want to achieve. And I'm worried about this happening to me or that risk, or I don't know if I'm going to have a third child, for example. And all of these kind of human emotional elements come into play. Mike, how do robo-advisory type products feed into that?
Right.
They're not particularly well developed. I think a lot of robo products, you fill in a questionnaire and they say, well, this is your profile and we'll give you something that meets that questionnaire. But everybody's slightly different to a questionnaire. And factors change. We're finding populations living much older. We're finding people have to fund their retirement for much longer periods. We're finding markets are changing in nature, and new markets are opening up. And very often the robo-advisor can't feel, as you say, those particular differences in risk or the human elements. But having said that, I think there still then is a role for the financial advisor and for professional people to assess risk and to assess the best way to meet that risk. What sort of products you use in that is increasingly moving towards indexation, because you can build an algorithmic index. Quite simply, what I do find is that it's going to be more and more difficult for the active manager, particularly if they underperform, particularly if they are not fully disclosing their costs, so their real performance numbers are much worse than even we led to believe. For them to find a role in either a robo-advisory world or, in fact, a world which I think will be a mix. I think we still will need the human touch and we'll still need financial advisors, but the products that we need to get there, I think, will increasingly be relatively simple, relatively transparent products that you can buy online, products that you can undertake and research yourself on what those products contain. And that's where the passive or index tracking industry, I think, is very well poised for 2020 and well beyond 2020.
Sure. And John, when we talk about accessibility, online accessibility, we know that mobile penetration in Africa in particular is expanding at rates that no one ever foresaw. It's expanding financial services. When we see the likes of Charles Schwab offering all of these services almost for nothing online, do you think, therefore, that we're really just opening up a new world of opportunity for new investors to enter the market?
Correct. We're broadening this market, and what we really are seeing is this idea of removing the black box. This approach of saying, give your money to somebody else and they will invest it for you. We're saying, take control, understand how that money is being invested. And the advance of technology and the kind of accessibility to mobile technology in places that 10, 15 years ago would have been very difficult to service with your traditional kind of financial products. they have access to it. You've seen huge advances in Kenya, in Ghana, in Nigeria, in this space, where people have access to these kinds of products. And I think even to people sitting in traditional markets who have used traditional old-fashioned products before, indexation offers a much cleaner, more transparent, easier to understand. You know what you're buying.
Yeah.
Fundamentally.
And we just have to take a short break, but it comes back to something that I've seen recently, and there's a disconnect between the so-called millennial generation, we now have the centennials coming after that, and financial advisors. So perhaps we're now finding a way to bridge that disconnect through transparency and through technology as well. We just need to take a short break from the Classic Business Investment Panel, which has been brought to you by Liberty.